raising inflation, rising interest rates, wage inflation. All this makes things difficult. If we don't change course, deals aren't just not going to work, right? I have two screens happening here, which is why I'm doing the weatherman news reporter turn here. But yeah, really excited. We're going to be talking more about multifamily real estate investing in today's changing economy. We've been in this world for at least the last 4 or 5 months. I think we're all feeling what the premise for this presentation is: raising inflation, rising interest rates, wage inflation, economy shortage, supply chain shortages. All this makes things difficult, not only on the acquisition side when you're purchasing a property, but it makes things difficult from an operations standpoint as well, right? Supply chain shortages, labor shortages for doing work, and it affects the way that we're able to get deals. And then of course it's going to affect the cash flow and execution as we're working through. We're going to be going through 9 steps and 9 things that we think you should look out for when you're looking into a multifamily syndication or looking to get in place an investment like this. What I'm alluding to right now is I'm going to be dipping in and out of this as a constant kind of thread, right? It's not going to be the case now where you can buy a multifamily property, flip it in a year, assuredly. Maybe you can, maybe you do something really well, right? But that is not something that I think folks can count on in the future. And what you should count on is cash flow, longer term holds, and really looking at the life cycle of a property, right? And having a good business plan that you can execute certainly against. So these, right, they change frequently. So these are the latest and greatest at the time of making this chart, but we're all feeling it, right? We're all feeling what these charts are showing. And without these line graphs, I think we all would know what's happening with inflation and wages. But there is a punchline here I do want to highlight. So inflation, of course, we know what's happened in the last few months or so, right? Wages also, people talk about wage inflation frequently, and you look at this chart and you see it going up and up and up, and that's one relationship that's apparent. Except what's not apparent, and I don't think what jumps out of these just by looking at these two charts, is wage inflation is not increasing at the same rate as rent inflation, right? And so you'll hear of operators increasing rents 20-25%. And the market may sustain that. The market may say that's what the market value of your 2-bedroom apartment, whatever square footage it is. They may say that's what you can charge. But people, their wages aren't increasing 20%. I think we all would love to get a 20% raise every year, right? It's not happening though. So there's definitely pain, from that regard, and it's something that all operators should be aware of. And it's kind of a lens that I think we should all, when we're looking at these properties, kind of put ourselves through, because it's going to affect occupancy, renter sentiment, and eventually, and lastly, the returns of the property, right? When occupancy dips, that's your number one impact to the NOI. So if we don't change course, rates are going to continue to increase. This is something that we're feeling now, right? As general partners and people trying to do this business. If we don't change course, deals aren't just not going to work, right? Because the debt service to get into these properties is often, it just doesn't facilitate. So it's going to require you to be creative, get creative financing, but also creative deal structure. First and foremost is paying for the talent. It all comes back down to the underwriting. Every action 1 through 9 that we're going to go through should all be reflected in that underwriting, so that that you have a business plan that is accurate to today's global economy, today's landscape, right? So paying for talent is one of those things that not only is it important to do from an execution standpoint and retention standpoint, maybe that's obvious, but what really important to do is to have that be reflected in the underwriting that you're putting together, right? So we want to really align our interests with the property management company, with our employees, and try to align our incentives so that we're all on the same team here. When our property management company is able to finally get over that 95% occupancy threshold, they are compensated for that. It's the right way to reward people, throughout this, right? And so we try to retain talent, and we try to focus on getting the best, crew we can possibly get. Interest rates are rising so much. You often see an operator purchase a property with a floating debt for the first 2 years, and they're going to do the repositioning. They're going to increase the occupancy. They're going to, add value to all the units and get everything spick and span and moving, right? And get that property singing and making a lot of money. By that time, 2 years probably passed, 3 years maybe passed, and they're going to refinance into the longer term debt. So there's two things that we really try to do. The second bullet saying new deals need to go under fixed rate debt, and that's true. And we're always looking for that fixed rate debt from day one. That's the best case scenario. And if it's not possible for the deal structure, what we always do, and we have been doing for quite some time, is purchasing a rate cap. I think interest rates right now for these types of assets are in the mid sixes, right? In March, we just bought a property. It was 600 something units with 3.1% of financing. And so now we're talking, that's double the interest rate. You can imagine debt payment that goes on these multi-million-dollar properties and what that can do to cash flow. And as I alluded to before, cash flow is really what's going to help you muster the storm. And it should be really what we're looking at, identifying the opportunity here. Going back to the point, if you can't get the fixed debt, you should fix your interest rate by purchasing a rate cap. A rate cap is when you have floating rate, like in the beginning, like we're talking about a bridge debt. Maybe 2 years, it's a floating rate. What you can do is you can purchase a rate cap. You'll give a big lump sum payment. And that's something that's also going back into the underwriting, right? You should understand that you're going to have to pay for this rate cap. If you can't fix your debt, you should definitely buy a rate cap, or you should make sure that the operators you're going to be working with do. It's all linked together, right? We're going to be talking about getting creative financially, getting creative with the seller in terms. Let's look a little bit more at this. So there's many ways to get creative too. What we're looking to do is develop more strategic partnerships, right? More equity partners that might bring a different skill set to the table, and try to find synergies that will increase the opportunities for everybody. Another good example of this is seeking new debt outside of agencies. So, going outside of Freddie, Fannie, we're working with some family offices, insurance companies, people who are looking for real estate backed, right? That's one of the great benefits of multifamily real estate, is that your cash on cash return, or your preferred, like I said, 8 to 9%, sometimes your 9% preferred return is backed by multifamily. And you'll get paid out before the general partners get paid, or the Class B investors get paid out. So agencies like family offices and insurance agencies are really excited about that kind of fixed income stream that is backed by something as solid as multifamily, which again, if the operator does correctly, they bought it and it's cash flowing. That's another great way. And then getting creative with the sellers and terms. Here's a really good example of this. We bought 600 some odd units in March. And what this was it's actually a 5 property portfolio across Kentucky and Winston-Salem. Now, the creativity there is really because we're leveraging relationships in both areas. But what I was most excited about there is that it's not like one seller came and had to sell 5 properties. We happened to tie these opportunities together into one capital raise. So we get better financing. We're getting the economies of scale of the partnerships we have in each one of these markets. And we're able to fix more of our debts and costs because of the bulk pricing you can get by doing things like this. So that's one way to get creative with the terms and all that. So costs. There's many ways to fix costs. As we're describing before, DeRosa Group's thesis really is to buy workforce housing. And now workforce for Freddie and Fannie it's not like Section 8 housing or anything like that. We're talking blue collar demographic workforce housing. We target that to be in the middle of the market. And like I said before, we're always trying to reposition these properties, add value, get contractors in there, and make them a more beautiful place to live and a place that everyone's happy to call home, right? So there's a significant amount of investment that goes into that, and not even the purchase of the property, right? So one deal I have in mind in talking about this is $3.7 million of just capital improvements to the property, which has more than doubled the property value in retrospect, and helped to increase rents, but also make people very happy to live there. To do that $3.7 million investment smartly, you should try to fix some of the costs of that and get the most effective economies of scale and leverage business partnerships where you can. Our general contractor in North Carolina, right? Not everybody uses general contractors. Sometimes we in North Carolina have a really great relationship with a general contractor called THS, and they do pretty much all of our work there. Here's what's great about that. Our general contractor is, we put together a scope of work, and then going back to kind of the through line through all of this, that's underwritten in the deal when we first got it. So it's everybody, we're able to ensure their payment and also ensure the returns that we are comfortable giving to our investors. And that's one way that you can really fix costs here. I'm going to skip over to 4 right now because it's tied into this. When the general contractor is doing that, buying in bulk, some of our properties, 330 units or a single property, right, or something like that. You don't really want to go to Lowe's to just buy 300 refrigerators. We have business partners in place and distribution centers buy these appliances in bulk with, right? So that really helps the general contractor keep their costs down. It keeps everybody happy, and it's in a good way to operate. So staff, I'm going to go backwards now, but staff, right, underwritten in the deal. We already said action number 1 is pay for your staff and make sure they're well taken care of and happy, and put that in the underwriting. And property manager in Kentucky, we have 1 property manager in Kentucky, and we have about 1,200 units in Kentucky, and that's leveraging the economies of scale here, and it's also helping to fix the cost of that whole portfolio in that metro. So cash flow is king. I want to address this slide though. Buying properties that are cash flowing day 1 will allow you to weather this storm. Matt Faircloth, the founder, he was investing through 2008. And what he would tell you is that the reason that he was able to weather that storm was because he purchased for cash flow. You want to force appreciation and you want to buy for cash flow. That allows you to hold these properties for however long is opportunistic, especially when you fix the cost and you fix the debt, right? Because cash flow day 1 could be different than cash flow day 365 if it's variable debt. Cash flow is king. It's going to protect your asset. It's going to protect your investors. It's going to allow you to really hold the property and execute the business plan that you want it to do, right? Because some people are going to be forced to sell, I think, in this economy. And that's something that we're all seeing already and feeling already. Operators who thought that they can buy a multifamily apartment building and then flip it, we were able to do for maybe the past 3 years. You're going to have to actually operate these properties now. So cash flow allows you to do that. All right, creative financing, another thing that we touched on before with getting creative in general, right? So fixing agency debt, local commercial banks and other alternatives. We touched on some really good ones, right? The insurance companies, family offices, anyone who wants exposure to real estate that is high up in the waterfall. And by waterfall, I mean the order of precedence in which people get paid out. Usually the agency is going to get paid first, and then your investors collecting a pref are going to be number 2. The general partners or the operators won't get paid until all the investors are paid. People who like that idea of getting exposure to multifamily real estate, getting that income that is also backed by an asset as reliable as multifamily, when somebody's done it the right way and it's cash flowing day 1 and you can meet all your debt service. Anyone who finds that attractive is going to be a good creative financer of potential deals. So family offices, insurance agencies, it's important that people are starting to look at some of these other options and kind of keeping their minds open, right? All right, action 7, conservative underwriting. This is action 1, 2, 3, 4, 5, 6, 7, 8, and 9, right? It all goes back to the underwriting. Everything that I said should be reflected in there. But I do want to extrapolate off this even more. It goes beyond just reflecting accurately the current state, and it gets into even more trying to be conservative in your projections as well, right? So if you're still going to underwrite your deals for a 15 to 20% rent bump like we had last year and maybe the year before, it would be a mistake. If you're counting on cap rates to compress more, I think you'd be making a mistake. More than just accurately reflecting everything we talked about through actions 1 through 6, you also have to be conservative in the go forward as well. Exploring the new normal. This just goes back to what we were talking about with cash flow and how it allows you to hold properties longer. That's part of the new normal. The other part is getting creative in your business trajectory and your focus, right? So multifamily investing, I think, is something that obviously I'm optimistic about, but we do also feel that it has a place in everyone's portfolio, but is not the only way to invest, right? And so we as operators are also interested in other ways to transform lives through real estate, also expose investors to real estate assets and provide great returns, but maybe a slightly different approach. And so here's just an example of that is maybe taking some of our apartments and serving a need for medium-term rentals, like 30 to 90-day rentals. High quality medium rents, I almost alluded to it at the conservative underwriting. This is one of my favorite ones that we talk about. And it goes also back to the thesis here at DeRosa Group. Serving workforce housing, right? Serving that demographic provides some stability that I don't think every asset class could accurately claim, right? Having high quality medium rents and serving middle class is a safer business practice, in my opinion. We're not trying to meet and exceed the medium rent of an asset, right? So if you're taking class B 2-bedroom. We're not trying to be the most expensive person on the block. We're trying to be somewhere in the middle. What Matt would usually say is take the medium and discount it by 10%. That's where we want to be underwriting to, and that's where we want to be, because that's going to help people the most, right? It's setting a real expectation, and it's also going to help us keep that occupancy to a place where we are going to cash flow the way that we project to. So it's important to going back again to the underwriting. It's important that to understand what the market requires, understand the expectations of the demographic, and try to meet those expectations in the most efficient way possible, and understanding the dangers of possibly exceeding those expectations, because you might not get a return on that investment, right? So, but the long game, I've been saying this throughout this presentation, right? It's very important. Just like you said, people for the past 18 months, probably longer, have been able to buy large multifamily, have it double in price, and sell it in a year. But it's important to understand that your operator and operators will need to develop the skills in the new economy as well, and the new way things, I feel, are going to happen, right? You're going to have to hold these properties longer term, and you're going to have to actually operate them, not like before, not like where you can buy an apartment and you're a construction company and can fix it and then sell it. You actually have to operate it as a business and with a long-term strategy plan. The winners in today's new economy will be those willing to hold and cash flow for the long term.